Hello, everyone. My name is Justina Mueller, and I'm a partner with James Moore and Company. I am joined today by John Van Duzer, also a partner with James Moore, and one of the leaders of our real estate team. John and I will be talking about the CARES Act, and we will start off with explaining the changes related to the qualified improvement property.
So I'll start out with the just kind of a general overview of what changed. So in the CARES Act, they fixed the technical glitch for qualified improvement property. So that's a real accountant's speak, but really dive in why that even matters to anybody. Let's kind of take a step back and look at the law and the history of the law. So pre-2018, before the Tax Cuts and Jobs Act, if you had interior improvements to a building and the tenant and the landlord were unrelated parties, you had what was called qualified leasehold improvements. The qualified leasehold improvements for depreciation purposes had a shorter life than buildings and also were eligible for bonus depreciation. So this was a significant benefit for landlords and tenants who made improvements to buildings because they could get the depreciation deductions in an accelerated manner. So when the Tax Cuts and Jobs Act was passed, they had this glitch in here where essentially the intent of Congress was to continue that treatment and even make it more favorable because they got rid of the unrelated landlord and tenant provision, but they wrote the law incorrectly. And so what resulted was you had leasehold improvements segregated into this special property type, but then it was not a shorter life and was not eligible for bonus depreciation. So it severely limited the ability to take those deductions on that property. And so what the CARES Act did was they fixed that error in the legislation. And so we call it a patch or correcting the glitch. And so it basically allowed qualified improvement property to have a 15-year life and then also be eligible for bonus depreciation. So kind of a quick overview, qualified improvement property is property that is an improvement to the interior portion of a building that's non-residential, so that's offices, shopping centers, that sort of thing. And the improvements have to be made by the taxpayer. So you got to be really careful in a situation where you have a tenant allowance versus direct tenant improvements. So it does get a little technical, but if you're making tenant improvements on a non-residential building, you're in that qualified improvement property zone. And then the improvements are they don't include like roofs, HVAC, or structural improvements, but that sort of thing. It really is the interior of the building. It has to be non-structural in nature as well. So
yeah, no elevators either.
No elevators. So that's the change and why it's important. The other big benefit is that any property, it was also retroactive to 2018 and 2019, which is a big change. And I think, Justina, you had a couple clients that you dealt with that were able to benefit from that retroactive provisions. Maybe you could tell us kind of, what you saw.
Yeah, so every time we do have a tax law change, especially when it goes retroactively, we looked at what we did for clients a year before and search for those opportunities. And I had a client who did purchase an office building in 2018 that required a pretty significant improvement. So when he negotiated his deal with the tenant, he committed to doing quite extensive improvements. Nothing structural though, but he did spend over $400,000 on those improvements. But when we filed 2018 return and the way the law was standing back then, we were only allowed to take a portion of that cost as a deduction because it was a 39-year property and not qualified for bonus depreciation. So we were allowed to take only 1/39th of it, which was roughly $10,000. So when the CARES Act was put in place, we realized that we could now apply those new rules to the building, to the improvements that were put in service in 2018. So now the client was allowed to take the remaining depreciation, just like if the rules were originally in place correctly. There was a special procedure we had to follow, and it's a long form that needs to be filed with the IRS. It's called a change in accounting method, but it ended up getting pretty much almost $400,000 deduction for the client in 2019.
Right. So you're able to go back look at what they did and harvest deductions even in a previous year. And then the way the IRS guidance was written, you don't even have to file like an amendment and go through the whole amended return. It's just a catch-up deduction on the current year tax return.
Exactly.
Right. So that's an awesome benefit for a taxpayer who, wants to be able to take advantage of this new law on things that they've already done in the past and generate cash, which really is the whole point of this and why it was in the coronavirus relief, is really to help taxpayers generate that cash.
Yeah, and that leads to the next topic you're going to be talking about, the net operating loss carryover, because for my client, it actually created a loss from operations because it was such a significant improvement. So I think the next portion of, we're going to be talking about the NOLs, and I'll continue my example.
Yeah, so tune into the next video where we talk about the net operating loss and what you can do with these extra deductions generated by qualified improvement property. So thanks, guys.
Thank you.